Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on the show today?
Well, we're going to talk about gold for a change, a new favorite that I introduced yesterday, and a little bit about lithium, the big bungee jumper.
Will $2,000 become the new base for gold or remain a ceiling it never really breaks through?
You know, Jim, this is now a really, really important question. During the past week, gold has managed to stay above $2,000. In the past 4 years, it's now gone over $2,000 twice. The first was in July, August of 2020, when the COVID pandemic was unfolding and they were opening the spigots to print money to keep everybody from falling into a deep recession and depression. But that failed. The second attempt was in March of last year when Russia invaded the Ukraine, but the geopolitical stress of that event quickly wore off and was kind of pounded by middle of last year when Jerome Powell finally acknowledged the inflation was not temporary. It needed to be crushed with a series of interest rate hikes that have not yet stopped. This current rally is brand new, and it's very different from the other rallies. And I look at the GLD ETF that trades on the New York Stock Exchange. This is the World Gold Council backed ETF, where there is actually physical gold backing the security that you can trade. It used to be 1/10 of an ounce. It's eroded to a little bit more due to administrative costs, but it gives you a daytime proxy of what the market thinks about gold. And I have a graph where I plot the daily change in the holdings. And the way the Spider Gold Trust works is when there's a dozen or so bankers who are designated with the right to buy these shares and actually deliver them to the trust in exchange for physical gold. At the same time, they can also short these GLD shares and buy physical gold in the bullion market and deliver the physical gold in exchange for the shares. Now, most of the time they would just buy shares they are short back in the open market. But there are cases where when the sort of retail and general public, maybe even institutional interest is very strong, strongly interested in the gold uptrend, they're in there buying, and that the bankers will see the price of the GLD exceed what they can buy the gold for. So they'll short the GLD and buy the physical gold, but then they end up, when the GLD keeps going up, they end up delivering the gold to cover their GLD short, and there you'll see then the trust's ounces go up or down, and every day this changes. Now, in that period from sort of March of 2020 until September or August of 2020 when it suddenly came to an end, we had solid days of increases in the GLD trust. There was strong retail interest. It washed over into the junior resource sector, as well as the producer sector. There was a lot of financing activity that during that sort of from June onwards until late in the year, when the party had ended and gold had dropped back below $2,000. And we saw a bit of that also in the first quarter of last year. But since the interest rate hikes began in June of last year, there has been gold retreated as low as $1,750. There has been a steady outflow of gold from the ETF. And there was a bit in March when the Silicon Valley Bank failed and people started to understand the nature of how banks work. Taking your deposits and promising them back at face value, but taking those proceeds and buying long bonds at really low interest rates, and then watching interest rates go up and the value of them go down, and this puts them in a pickle if people want to withdraw the money, because then they have to sell these long bonds at a loss. And with the prospect that inflation is not coming down as quickly as the Federal Reserve would like, and will probably have to raise it even higher, the situation became kind of hairy, and there's still a strong risk that people will move their money out of bonds and out of the banks, but they're not really putting it into gold. We saw a bit of a spike of increase in gold holdings. There was one 300,000 ounce day, but it's been quite muted since then. Instead, they're finally figuring out they need to put their money into money market funds, which are not part of what gets loaned out or reinvested in something else. It's all in short-term securities. So the anxiety of the retail investor out there is not mapping into gold interest. And yet the price of gold has gone up since about September, October of last year. And that tells me that there is an underlying buying power that's taking up the bullion. And like in London goes up, and then in the day trading in the New York Stock Exchange, the GLD ends up to follow that. So it's a different type of buying, a buying that's hedging against enormous uncertainty. What could these uncertainties be? Well, there is still this risk that more bank runs could happen. It could turn into a contagion. People make comparisons to 2008. It was in 2007 that we saw the Bear Stearns go down, and we saw the countrywide disaster, all the commercial paper disasters. We already kind of had a pre-warning of what was to come, and that all of course fell apart in September 2008. But the other thing that's looming is the debt ceiling, the need to raise the debt ceiling by sometime by June, July, and the Republican Party is determined to not approve this unless changes are made, which they cannot seem to come up with. They say we need you to sit down and tell us what you're going to lower, what budgets you're going to axe. And of course, Biden this time around, learning from what happened in 2011, is sort of saying, well, we're not going to negotiate this. This debt ceiling is to approve stuff that Congress has already approved, and we're not going to negotiate you making new changes out there in terms of the spending plans just to suit your political fancies. So this could become a serious train wreck because there's one party that really could not care less about America's health as a whole. They're probably not paying much attention to what we're seeing around the world as all these countries, like you can split the world into three groups. There's the hardcore autocratic countries like China and Russia. Then there's these sort of semi-free countries like India and Brazil. And then there's the democratic countries such as in Europe and the United States and Canada. And with the United States, it's becoming increasingly questionable whether or not it has any interest in staying a democracy. So this middle group are now looking to countries like Russia and China and sort of thinking, we don't see United States as a reliable partner on anything anymore, and all this trade is being executed in U.S. dollars. Let's sit down and figure out if we can do trade in our own currencies. And this debt ceiling thing looming, how can this do anything but make this desire to back away from any reliance on the U.S. dollar? How can this ameliorate this desire? So I think we're seeing deep buying in gold. And from a market perspective, after a pretty lousy March, the market's been better in the past week. And this is the perverse thing. The juniors, whether they're at nickel, lithium, or whatever, it doesn't matter. When gold is up, there is an upwelling of sentiment in the sector, and you can see it. You can feel it on a day like today, Friday, when gold got whacked down. Well, then you can see sort of the air come out of it a bit. But if we can see gold base at $2,000 and not always be the ceiling that it struggles to get through and maybe stays up a little bit and then sags back down to 1800, this will be really important because it will set the stage for the general public finally getting it that there's a bull cycle here, that the next question is, when will gold go to 2,500? When will it go to 3,000? Will some of these crazier possibilities like $5,000 plus become reality? Well, yeah, if you pull the plug on America, that certainly will happen, though I'm not sure that will make the resource juniors their projects worth any more if costs are inflating in U.S. dollars. But we are looking at a scenario where there is a rethinking of the role of gold in people's asset portfolios. And the nice thing is, it's not being driven by the public. The retail public is not gaga about gold. So this is good, because when the retail public, such as in the middle of 2020, is all over gold, and as it was in sort of 2010, 2011, then it probably doesn't have much staying power. So I think there's a very good chance that during the second quarter, we will see gold establish a base above $2,000, and then that'll be just where, if it starts to go to that, people will just nail a bit to the wall and buy what they can. And that is what the junior space needs. It needs this $2,000 gold, which is more than just reflecting the inflation of the last while. It needs this to become reality. It lowers the bar for what counts as economic. All these ounces in the ground plays at $2,000, they start being in the money pretty good. And if you start adding $200, $400, get to $2,500, there's tremendous leverage in these ounces in the ground. And of course, for the exploration juniors, when you have a higher real gold price, then it also lowers the bar in terms of what grade you need in order to count an intersection as the beginning of a new discovery. So will it happen? One can't tell for sure, but I think everything's lining up that we will soon see $2,000 as the base for gold rather than the ceiling. And if this happens in the next month or so, then the PDAC curse will be most definitely violated this year. At the moment, it's still sort of hanging in there. The market hasn't plunged, but it also hasn't taken off in a clear violation of the PDAC curse.
Which of your 2023 favorites is the best proxy for gold?
Yesterday, on April 13th, I introduced a brand new company as a 2023 KRO favorite. Its name is West Vault Mining, Inc. It closed at $1.02. It has about 60.2 million shares fully diluted. It was reorganized with a 10-for-1 rollback back in 2020 or something like that, and it's pretty much flatlined since then. This company used to be called West Kirkland Mining. In April 2014, it did a deal to acquire the Hasbrook project from Allied Nevada, which about a year or so later went bankrupt. They have invested a total of $48 million both to acquire and advance this project since 2014. They, of course, had to suffer that brutal 10-for-1 rollback. Most of those financing back then were done at 15 cents pre-rollback. So just about everybody who originally backed this company is underwater at the current valuation, which is about $60 million. Now, what is Hasbrook? Hasbrook project consists of 3 low sulfidation epithermal systems just to the southwest of Tonopah in the Walker Lane of Nevada. Hasbrook itself was discovered back in 1902, and it had small-scale mining pecking away at veins until about 1924. And Hill of Gold is not far away. It's a more recent development. That whole area was dead until about the mid-70s when exploration was resumed. Since then, various groups have had cracks at both the Three Hills and the Hasbrook low sulfidation epithermal systems. In 2002, Newmont ended up owning it through its merger with Euro-Nevada, which had absorbed various other entities that had these projects along the way. And they unloaded it onto Vista Gold, which was really sort of an optionality play, holding all these gold systems run through Rick Rule's organization that would wait for the gold price to change and pull these stocks, these projects into the money. And that, of course, did happen during the 2000s when the China super cycle changed everything, and then with the financial crisis, gold finally made it above above $1,000, almost made it to $2,000. And Vista itself spun it out as part of this whole package of properties. It spun out to Allied Nevada, and then West Kirkland acquired it, and they produced a pre-feasibility study in 2016, and they also got a lot of the key permits left. This is BLM land, so it's not difficult like U.S. Forest Service land, and there are, of course, still permits that would need to be applied for once you make a construction decision, but those ones typically are not very difficult. So most of the key permitting has been done. But of course, in 2016, the gold had tanked back below $1,300, so the whole project has been pretty much stalled. So they did the rollback, bit the bullet. Peter Palmito's Sun Valley was a backer back then. It's still the largest shareholder of the company with about 26%. Eric Sprott and Ruffer, they own another 22%. So, 70% of the stock is held by several, well-known gold entities, gold backing groups. And the decision this company has made is we are not going to get the yellow dump trucks going and dig holes in the ground and move rocks around and crush them and hope to see some gold pour out of the furnace. No, they are treating this as an optionality play. So they updated the PFS in January because, in the last 5 years with the inflation that has arisen post-COVID, we don't know what any of these economic studies really mean today. I mean, do you inflate them by 20%? How much more have costs increased than inflation itself? And the numbers that they came out with in January, they are pretty good. This is not a monster spectacular project. They envision a 8-year mine life. The first 2 years would be mining Three Hills at 15,000 tons per day. This would be open pit, and it would be heap leached because all the mineralization in the mine plan is oxidized. And then they would, and they structured it so that they spend about $66 million in the first year to develop Three Hills, and then in the second year of mining Three Hills, they spend another $111 million or so to develop Hasbrook at 17,500. Now, Three Hills depletes within 2 years. It has no silver credit, but the Hasbrook has a silver credit. The recoveries are, for the silver are not very good. It's only 18.3% for silver, but the gold recovery at 74.6%, that is pretty good. Now, total CapEx from, the initial capital, the expansion capital, and the sustaining capital, it works out to about $222 million. OpEx is $10.36 a ton, of which $4 is per mined ton ore, and $4.67 per processed ton of ore. And these are this economic study was done in imperial units. These are TONs, the short tons, not the metric tons that everybody uses. They also use ounce per ton. The total resource is just over 44 million tons. It runs 0.017 ounce per ton and 0.239 ounce per ton silver. And with these recoveries over this 8-year mine life, it would yield 561,000 ounces and 1.9 million ounces silver. And that's not very huge. We're talking about 70,000 ounces of gold a year, so it doesn't even hit that 100,000 ounce threshold. But there is expansion potential. There's the Hill of Gold property, which they acquired for $250,000 a few years ago, which is nearby. And there's also surrounding land, which I'm not sure who owns it, but eventually this whole area could be consolidated. So their idea is to wait this out. They've got $4 million. Sandy McVeigh is the CEO. Peter Palmito is the chairman. Other highly respected directors are Peter LaBelle and Stephen Quinn. So these are strong people. The stock is well owned. I don't understand why it's only at $1.02. I've done the number crunching on it. They're at their base case price of $17.90 an ounce and for gold and $22.50 for silver. It yielded an internal rate of return after tax of 51% and the net present value was $206 million US dollars at 5% and $149 million dollars at 10%. If you use a 0.74 Canadian dollar US exchange rate and the 60.2 million fully diluted, that gets into price equivalents of $4.63 for the 5% discount rate and $3.34 per share for the 10% discount rate. And the industry prefers to use 5%, but investors can choose whichever they want. And because this is now sort of parked in the feasibility permitting stage, though they're not doing anything, under my rational speculation model, fair speculative outcome is 50% to 75% of these target outcomes. And that gives you, when you use those numbers, that gives you a price range of $1.67 to $2.51, which would be fair value right now, using the 10% discount rate, and $2.32 to $3.47 at a 5% discount rate. So clearly at this $2 price, this represents a good speculative value, which is why I've made it a good speculative value. And I'm arguing that this stock could, overnight reprice to, let's say $1.50, $2 quite quickly. It's kind of overlooked. Perhaps it's not followed by other institutions because it is relatively small. But if we do get gold basing at $2,000 and people start to legitimately dream about, $2,200, $2,400, $2,500 as new real prices, then a play like that has a lot of leverage. And I've pretty much sort of emulated the OR schedule that they have, created my own discounted cash flow model. And it's about 10% lower than what their model in their technical report comes up with, because I can't quite do all the tax pool manipulations that they can. But so at $1,800, the ultimate net present value per share range under my model is $3 to $4.27, and at the price gold was at on Thursday at 2,048, that pops up to $4.48 to $6.10 for that 5% to 10% range. And when you put it up to 2,500, you're talking like a $7 to $9. So here we see this tremendous leverage. A 25% increase in the price of gold could result in a 400 to 500% increase in the value of the stock. And why would this happen? Well, some mid-tier mining company would issue its inflated paper, but because it's a diversified mid-tier mining company, there would be liquidity, so all the shareholders would be able to, at some point cash out their position by just selling it into whatever institutional market supports the mid-tier producer. So this is what I call a leveraged play on gold, rather than just own gold and watch it grind up slowly and maybe fall through that ceiling again and not quite turn it into a base. Here I have the leverage of substantial multiples of upside. And the reason they called it West Vault instead of West Kirkland, I don't know why it was called West Kirkland, but they literally even have a logo that they see this company as gold stored in the ground, all the grunt work done to demonstrate what's the metallurgy, what are the recoveries, what's the optimal mining scenario for what we have, all the key permits. They spent this dreary bear market of the past decade getting this all together, and the market has not rewarded it. And that's why I've made West Vault Mining Inc. a favorite. It's only this one gold project. They have no plans to acquire other stuff. They are just waiting for the price of gold to come up, the general bull market to begin, and the mid-tier mining companies ready to take over, competing with each other to put this into production in a good jurisdiction. Outside Tonopah is just basically an arid desert area. There's nothing nice about it, and it has a mining history, and it should be able to be developed quite quickly once somebody says we're going to do it.
Well, yellow gold struggles to make $2,000 its new base. How far will white gold fall before it hits bottom?
Well, starting in December, lithium carbonate has done the equivalent of a bungee jumper jumping off a very, very high bridge. And usually there's water at the bottom of the bridge, but sometimes the bungee jumpers are crazy and the water is dry like it is in many rivers in the United States thanks to the drought. And so the fear is always, okay, did they calculate my weight and the relationship with the stretch of the cord properly? When does this free fall stop and I bounce up and then bounce up and down until they're basically hanging above the ground? Or is it going to have been miscalculated and I'm going to smash into the ground and be finished, kersplat? And so we have seen the price of lithium carbonate, which was as high as $36 a pound in early December. On Thursday, it was down to the equivalent of $12.38 a pound. And this is even worse than what happened in early 2018. The whole lithium mania 1.0 had sort of started in this $10 to $12 a pound range, which was a good enough price to get all these Australian pegmatites delineated and developed. But then in early 2018, it dropped below $10, based at $5, and spent there until about early first quarter of 2019, and that's when it began a slide that didn't bottom until about $3 a pound in mid-2020 when COVID pandemic was rampaging and the whole economy appeared to be stalled. And the up ramp started in middle of July of 2021, and that was fairly steep. It got up over $30 by early 2022, and it stayed above $30 all of last year. This plunge is even steeper. So everybody's thinking, is this going to be like back in 2018, when the Australians mobilized their pegmatite lithium sourced supply? They overwhelmed the needs of the nascent EV sector and crushed the price. Well, because it's happened before, people fear it can happen again. And so the big debate is, where does this plunge stop? Is it $10 a pound where it stops, or is it going to crash down to $5 a pound, or perhaps even worse? And when you're watching this free fall, this bungee jumper free fall, it's not fun if you're long lithium stocks. But I would say that $10 is going to be the limit that this bungee cord stretches. And the reason is, it's very interesting. In December, these various publications that track these critical mineral prices, rare earth prices, and lithium carbonate prices, they're not really reporting the results of a market. These are prices that they come up with talking to various traders who tell them what the bid and ask is and where stuff has been transacting, but there's no actual market data showing how much volume changed hands that validate this. Well, I started picking up all this discussion about weak demand, and this was peculiar in December because, China had been going strong even though it had its zero COVID policy, and all of a sudden, when they finally dumped the zero COVID policy, and we didn't hear anything more about every third person catching COVID and every 10th person dying from it, and they seem to have gotten beyond it, we would have expected to see the metal prices start to strengthen as China gets back in gear, gets producing again, starts shipping stuff abroad. But there was this endless chatter within these various publications about, weak downstream demand. The EV sector is not really as strong as it was. And the first quarter is traditionally a weak time for building these electric vehicles anyways. And yet now we're starting to hear that China had a much better quarter than people expected, that exports were up substantially in March. So I think what we're seeing is, not that much spodumene and lithium carbonate traded at these high prices, because most of the lithium concentrates and the carbonates those are sold early in advance at long-term prices. And those would have been below $15 a pound, not up there in $30, $35 per pound. But because they ran out of material, they had to start paying that. So I think there's been this concerted effort by the car makers and the battery makers to just kind of slow down, draw down their stockpiles, their inventories. Don't go out there and buy this stuff. Don't compete with each other. Let's stand back and talk about slowdowns and let the price come down to reality. And as far as the producers are concerned, I think the sophisticated ones always knew that $30, $35 a pound was going to be a short-lived windfall. Those who managed to sell some at that price were happy. I don't think they're particularly concerned about it going down here in the $10 to $15 a pound range. Albemarle itself has said that if you want your EV goals met by 2030, you better accept a minimum $9 a pound. And of course, Albemarle made a $5.5 billion Australian offer to acquire Liontown and its Kathleen Valley project, which was rebuffed, and that was at $2.50 Australian per share, and now Liontown is at $2.70. So the fact that lithium carbonate's bungee jumping down here, plunging towards $10, that hasn't seemed to have really bothered anybody. And I think we will quite shortly see that it reaches this limit. It'll probably have a rebound. That'll get everybody excited. But this is not like gold, where you're hoping that gold will go up and then keep going and going and going, because gold doesn't really matter for anything. It doesn't go into a battery to make a car run. It doesn't, define the price of anything except jewelry. But lithium does. So having too high a lithium price harms even the interests of the producers. So I think we'll see this bounce happen soon, not go much past below $10, bounce somewhere between 10 and 20, and then we'll see where it stabilizes. But the forward-going assumption is, assume $10 a pound and look at the matrix that I've created and see what your lithium oxide grade is and what the rock value is. And you'll find that $10 a pound, anything with 1% or better, is well in the money in terms of rock value. And in terms of comparability with gold, what gold grades when it's open pitable, like for example the Hasbrook deposit, that's a much lower rock value. So I think in the next quarter here, this quarter here, we'll see the lithium carbonate price stabilize at $10 or higher, and then that will kick off Lithium Mania 2.0 as people stop watching this free-falling price, and that will also help violate the PDAC curse that every year sends all the resource juniors plunging into the garbage can by summer, with then maybe a possibility of emerging in September. So the white gold, right now people are still watching it free fall, but I think we're very close to seeing it rebound and not go kersplat and stay down for the count like it did during Lithium Mania 1.0, which ran from 2015 to 2018. We are just beginning Lithium Mania 2.0, and the Canadian juniors that are still busy scrounging, acquiring land packages in places like Canada and even farther abroad like Zimbabwe, I think they're going to have a good time as both white gold and yellow gold dominate the market's attention.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.